Have you ever kind of daydreamed about being a big shot insurance mogul? Sitting in a big leather chair, collecting cash from clients, setting your own terms. Well, what if I told you that you could start your own little insurance empire for the stock market? That's what we're diving into today. So let's get your business off the ground.
Okay, let me just ask you this. What if you could literally get paid, we're talking cold, hard cash, just for agreeing to buy a stock you already want, but at a discount? I know, it sounds a little too good to be true, right? But stick with me, because that's exactly what selling puts is all about. So, let's open the doors to your new venture. The absolute best way to wrap your head around selling puts is to picture yourself as the founder, CEO, and, well, the only employee of your own little insurance company. But you're not insuring cars, you're insuring stocks. And guess what? You're the boss.
Here's the business model in a nutshell. When you sell a put, you're the insurance company. Some other investor, who already owns a stock and is nervous it might drop, comes to you. They pay you cash, which is called a premium, for some peace of mind. In exchange, you give them your word, a promise really, that if their stock falls below a certain price, you'll step in and buy it from them. You're basically selling them a financial safety net.
Now, in any business, you've got two key players. First, there's you, the insurer. Your job? Collect that beautiful cash fee, the premium. But, and this is a big but, you now have an obligation. If things go south for your client, you have to buy that stock. Then there's your client, the one buying the insurance. They pay you that fee, and for them, it buys a right, but not an obligation, to make you buy their shares. See the difference? They get the choice, you get the obligation.
All right, every new mogul needs to know the lingo, so let's get you sounding like a pro. First up, the premium. This is the best part. It's the cash your client pays you the moment you make the deal. And here's the magic phrase. It's yours to keep, no matter what. Next, the strike price. This is the agreed-upon price in the contract. If the stock tumbles, this is the exact price you've promised to buy it at. And finally, the expiration date. This insurance policy doesn't last forever. This is the day the contract officially ends, and poof, your obligation is gone.
Okay, that's enough theory. You've got your imaginary business cards printed, you know the lingo. Let's walk through a real-world example. Let's follow the money. Okay, so imagine a company, we'll call it ABC stock, is trading at $100 a share. You've done your research, you like the company, but $100 feels a bit rich. You'd be a super happy buyer at $95. So instead of just waiting around, you open for business. You sell one put contract with a strike price of $95. The second you do that, bam, you collect a $300 premium. That's $3 per share times 100 shares. That money is in your account instantly. And now, you just wait. Now, there is one little catch. It's a pretty important one. Your broker, the one who's making all this happen, knows you just promised to potentially buy $9,500 worth of stock. So they're going to want to make sure you're good for it. They'll require you to have that cash sitting there reserved or have enough margin to cover the deal. After all, you can't be an insurance mogul who can't pay their claims. So why even bother with all this? Well, it's because this whole setup can lead to two, and they're both great, potential outcomes. This is where your new business really starts to pay off.
The first best case scenario is what I like to think of as the free money outcome. I mean, who doesn't like the sound of that? This is what happens when you get paid just for being right.
Okay, so if the expiration date rolls around and ABC stock is trading anywhere above your $95 strike price, well, think about it. Your client has zero reason to use their insurance. Why on earth would they sell their stock to you for $95 when they can just sell it on the market for more? So the policy just expires. It becomes worthless. And you just keep that $300 premium. That's a 3.2% return on your collateral, and you didn't have to do anything else.
But what if the stock does drop? Is it game over? Not at all. This actually leads us to the second and arguably just as awesome outcome. You get to buy the stock you wanted from the start, but at a sweet, sweet discount.
Right. So if ABC falls below 95, your client makes a claim. You are now on the hook to buy 100 shares at $95 each. But remember that $300 premium you pocketed? It's still yours. That cash basically acts like a coupon. Your real cost isn't $95 a share. It's the $95 strike price minus the $3 per share premium you already got. Your effective cost is $92. You just snagged the stock you wanted at an 8% discount from where it was trading. Not bad.
Okay, it's all been sunshine and rainbows so far. But this is the insurance business. And in the insurance business, sometimes disaster strikes. The phone rings,
and it's a client with a very, very big claim. We have to talk about the risk.
So, what's the big scary monster in the closet here? Well, it's actually pretty simple. The main risk is that you have to buy those shares at the strike price, even if the stock's actual market price falls way, way below that level. Your price is locked in no matter how far the stock plunges. Let's play out a true nightmare scenario, just so we're crystal clear. Let's say you sell 10 put contracts on XYZ Inc. at a $40 strike. You collect a very nice $5,000 premium. You're feeling good. Then, the news breaks. XYZ was a complete fraud. The stock goes to zero. Your client, who is probably pretty happy they bought your insurance, exercises their right to sell you their worthless shares for $40 each. You are legally forced to pay $40,000 for stock that's worth nothing. After you factor in the premium you collected, you're looking at a devastating $35,000 loss. That's the risk you're taking.
Okay, that disaster scenario is terrifying. I get it. But the good news is it's almost always caused by rookie mistakes that you can totally avoid. So, how do you not go bankrupt? Here are the top 5 pitfalls. Number 1, just a basic lack of understanding of how options work. 2, terrible risk management. Betting the entire farm on one trade. 3, choosing the wrong options, getting way too greedy with your prices. 4, letting your emotions run the show. Panic selling, FOMO, all that bad stuff. And finally, number 5, simple execution mistakes, like using the wrong kind of order in your brokerage account.
So, we've seen the good, the bad, and the downright ugly. Now for the million-dollar question, is this whole stock market insurance mogul thing actually right for you? It's time for a little gut check.
Here's the most important takeaway. This strategy is really for patient investors, people who actually enjoy doing their homework on a company. You have to go into every single trade thinking of it as a way to buy a stock you want. The premium you collect, that's just a fantastic side benefit. If you're only in it for the premium income, you're setting yourself up for trouble.
So, what are the golden rules for running a successful insurance business? Here's your cheat sheet. Rule number 1, and this is the most important, only sell puts on high-quality stocks you'd be genuinely excited to own. Rule 2, always, always, always calculate your net price. That's the strike price minus the premium before you place the trade. Rule 3, use smart position sizing. Don't risk your entire portfolio on one policy. And a pro tip for Rule 4, a great time to sell insurance is when everyone else is a little scared, like during those brief market dips.
Oh, and one last thing no mogul can forget, the tax man. It works like this. If the option just expires and you keep the cash, that premium is taxed as a short-term capital gain. Simple as that. But if you do end up buying the stock, the premium isn't taxed right away. Instead, it just lowers your cost basis, which is actually great because it means you'll pay less in capital gains tax down the road when you eventually sell those shares. It's a key detail you've got to know.
Which brings us to our final question. When you really get down to it, is selling puts a sophisticated investment strategy, or is it just a glorified gamble? Well, the answer is, it's up to you. If you sell puts on some random stock you know nothing about just to chase a quick buck, it's gambling, plain and simple. But if you do your homework and you only sell insurance on great companies at prices you'd be happy to pay, well then it might just be one of the smartest tools in your entire investing toolbox. The difference? It all comes down to the homework you do before you ever click that button.